certified fraud examiner in collaboration with EasyPathUni. The original template is provided by the Association of Certified Fraud Examiners and has been reviewed by Yazan Abougush. Welcome back to the deep dive. Today, we're tackling something that might seem a bit dry at first glance: financial reports.
Right, lots of numbers, footnotes.
Exactly. But trust me, underneath all that, there's often a story, sometimes a deceptive one. We're diving deep into detecting fraudulent financial reports.
It's a critical skill, really, understanding the true health of an organization.
Absolutely. Our mission today, to give you the tools, the insights to see behind those numbers. Think of it as a shortcut to spotting deception without getting lost in the weeds.
And our guide for this is pretty practical. We're using a comprehensive checklist designed specifically to sniff out potential financial fraud.
A checklist. Sounds useful.
Very. It's detailed, structured, takes you from the basics, like internal controls, right through to specific red flags in the accounts, and even the pressures that might drive fraud. It's a solid roadmap.
Okay, fantastic. So for you listening, we want you well-informed. We'll hit key insights, some surprising facts, practical signs of trouble, basically help you develop your own financial fraud radar. Ready to unpack this?
Let's do it.
Right. So where do we even begin? Like, what's the absolute foundation for a healthy financial setup in a company? Before the numbers, what needs to be there?
Well, it really starts with things that sound basic, but are often, missed first. Properly maintained accounting records.
Meaning accurate, up-to-date?
Exactly. Orderly, complete. But just as vital is having enough accounting employees, an adequate number.
Okay, why is headcount so important there?
Because it allows for proper segregation of duties. That's absolutely key.
Segregation of duties, meaning?
It means no single person controls an entire financial process from beginning to end. Like, the same person shouldn't be able to request a payment, approve it, and record it in the books.
Ah, I see. Too much power in one pair of hands. Creates opportunity.
Precisely. You need those checks and balances built in. It removes the temptation by removing the opportunity.
Makes sense. What about an internal audit team? Are they like the company police?
Not exactly police, but they're definitely a crucial safeguard. An effective internal audit staff is more strategic.
How so?
They focus on high-risk areas, sniff out vulnerabilities, check if the controls are actually working, and, importantly, their presence signals that fraud prevention is taken seriously.
So they're about prevention too, not just catching things after the fact.
Very much so. They're an early warning system.
Okay. This leads to internal controls generally. It's not just having controls written down somewhere, is it?
Not at all.
Yeah.
The organization has to establish and maintain proper controls, sure, but critically, everyone needs to embrace the concept.
Embrace it. What does that look like?
It means senior managers, employees, they all understand why the controls matter for the company and for their own roles. And leadership support has to be visible.
So the bosses need to walk the talk.
Absolutely. If senior management champions controls, it sets the tone for the whole organization. Integrity becomes part of the culture, not just a rule book.
Right. But what if the culture is good, controls seem okay, but the company sets these completely wild financial targets, unrealistic goals?
That's a huge danger zone. Unrealistic financial goals put immense pressure on management and employees.
Pressure to do what?
Pressure to commit fraud, frankly, to manipulate numbers just to hit those impossible targets. Ideally, a company hits its goals legitimately.
And if they don't?
Failures need to be researched, understood, explained openly, not, papered over with creative accounting.
What about the overall financial picture, like stable performance, good banking relationships?
Yes, definitely. Stable or ideally increasing financial performance is a good sign. Any big dips or instability need a closer look.
Because that could be a sign of trouble being hidden.
Potentially, yes. And stable relationships with the banks matter too. If a company's always chopping and changing banks, struggling for credit, that suggests underlying stress.
It's interesting how these foundational checks, seemingly basic stuff, are so critical but maybe easily overlooked.
In the first place, cracks appear.
Okay, let's move to the numbers themselves. This is where it gets really interesting, I think. Once you've looked at the foundation, where do you start digging in the financial statements? What are those immediate red flags?
Right now we're looking for anomalies in the actual figures. First off, unrealistic changes or sudden big jumps in account balances.
Like what?
Well, you have to ask, are these balances realistic for this company, given its size, its age, its industry? If a small tech startup suddenly shows massive accounts receivable.
That doesn't match its sales growth.
Exactly. That screams fictitious revenue, recording sales that just didn't happen.
So like the classic example, the books say there's a warehouse full of valuable inventory.
But you go look, and it's half empty, or the stuff is obsolete.
Right. So you need to verify the physical assets.
You absolutely must. Physical counts, inspections. Do the assets listed actually exist in the amounts and values claimed? If not, that points towards improper asset valuation.
What about big shifts in revenue or expenses? Not just the amount, but the type.
Good point. Significant changes in the nature of revenues or expenses should raise questions. Why the change? Is it a real shift in business, or are they reclassifying things to make performance look better?
And isolated large transactions.
Definitely watch out for those. If one or just a few big deals make up a huge chunk of an account balance, you need to understand them thoroughly.
Especially those end-of-quarter miracles, right? Those last-minute deals that save the day.
Ah, yes, the 11th hour transactions. You absolutely scrutinize significant deals happening right at the period end that just happen to boost results.
Particularly if they're complex or unusual.
Precisely. Doesn't mean they're all fraudulent, but they warrant a very close look. It could be improper timing, shifting revenue forward, or expenses back.
And generally, you'd expect results to be fairly steady period to period unless there's a good reason.
Right. Big unexplained swings, either up or down, are a concern. Consistency or explainable variance is key.
Okay, here's a classic one. Earnings growth looks great on paper, but the company isn't generating actual cash.
The mismatch between profit and cash flow. Yes, that's a major, major warning sign.
Why is that so critical?
Because earnings, can be manipulated through accounting choices. Aggressive revenue recognition, delaying expenses.
Fictitious sales.
All that. But cash flow from operations, that's the real money moving in and out from the core business. It's much harder to fake.
So if profits are soaring, but the cash isn't actually coming in...
It's a huge red flag that those profits might not be real. You have to investigate that immediately. Often points to fictitious revenue or timing issues. Got it. Okay, let's broaden out again. Beyond the numbers and the internal setup, what about external pressures or the internal environment? Things that might push a company towards fraud even if controls look okay. These pressures can be incredibly powerful motivators. For instance, significant pressure to raise capital just to stay competitive.
Needing money to survive or grow?
Exactly. Or maybe the company just has insufficient working capital, constantly scrambling. That creates immense pressure on management to, shall we say, enhance the results to attract funding or loans.
What about things based on estimates, not hard numbers?
Oh, that's a big area.
Yeah.
When assets, liabilities, revenues, or expenses rely heavily on significant estimates.
Like valuing complex assets or future liabilities.
Precisely. Especially if those estimates involve unusually subjective judgments or uncertainties, or if they could change significantly soon and have a major financial impact.
Because that subjectivity creates wiggle room for manipulation?
It creates a lever, yes. Especially under pressure. It's where accounting judgment can blur into, well, deception, think improper asset valuation, or even hiding bad news through disclosure schemes.
We often celebrate fast growth, but you're saying super fast growth can actually be suspicious.
It absolutely can be. Unusually rapid growth or profitability, especially way out of line with industry peers. That's a classic fraud indicator.
Too good to be true.
Often, yes. Fraudulent schemes frequently paint a picture of unsustainable growth to lure investors. It needs investigation.
Any other vulnerabilities?
Sure. High vulnerability to interest rate changes, for example. When your health is so tied to external factors you can't control, the temptation to hide financial stress increases.
What about incentive programs? Can they backfire, like being too aggressive?
Definitely. Unrealistically aggressive sales or profit incentive programs can put crushing pressure on employees.
To hit targets at any cost.
Exactly. It creates a perverse incentive, potentially driving people to commit fraud just to get their bonus or keep their job. Performance metrics become triggers for misconduct.
And what if the company itself is facing, like, an existential threat, bankruptcy, takeover?
Huge motivator for fraud. A threat of imminent bankruptcy, foreclosure, or a hostile takeover dramatically increases the risk. Desperation breeds bad decisions.
Or maybe a big deal is pending.
Yes, if there's a high chance of adverse consequences on a major pending deal, a merger, a big contract, if poor results come out, the pressure to manipulate becomes extreme.
Protect the deal at all costs.
Right. and a particularly toxic situation.
Yeah.
A poor financial position combined with management having personally guaranteed company debts.
Oh, so their personal wealth is on the line.
Exactly. That creates a powerful personal motive for fraud to prop up the company's numbers.
You mentioned operating on crisis basis. That sounds chaotic even without fraud.
It is like trying to run a ship while constantly putting out fires.
How does that chaos enable fraud specifically?
Well, when you're always in crisis mode, proper procedures get bypassed, oversight weakens, documentation gets sloppy, budgeting and planning go out the window.
Creates gaps where things can slip through.
Massive gaps. It struggles to monitor goals, control spending, predict cash flow. It's an environment where fraud can easily hide and fester.
And basic cash flow problems like trouble collecting money owed.
Absolutely fundamental red flags. Difficulty collecting receivables, persistent cash flow shortages. These signal something's likely broken in the core business and needs urgent investigation.
One less pressure point, depending too much on just one or two products.
Yes, especially if those products could become obsolete quickly. Think tech, fashion maybe?
Puts all the eggs in one basket.
Exactly. If that key product falters, the whole company is threatened. That intense pressure significantly elevates the fraud risk. It really begs the question, doesn't it? How much pressure is too much?
That's the million-dollar question, tying so much of this together. Okay, so given all these risks and pressures, what are the safeguards, the layers of protection? What should companies do proactively for transparency?
Transparency really starts with the disclosures. Adequate disclosures in the financials and the footnotes are crucial.
Not just burying things in fine print.
Right. Footnotes need to clearly explain complex issues. And everything must follow GAAP, generally accepted accounting principles.
GAAP, the rulebook for accounting.
Essentially, yes. It's the common language ensuring reports are comparable, transparent, and not misleading. Deviating from GAAP without justification is a huge warning sign, often pointing to improper disclosure schemes, trying to hide something.
And the external auditors, they're the independent eyes, right?
A vital layer. They should periodically review the financials, give an opinion on their fairness, look for significant misstatements or omissions. Their independence is key.
What about employees? If they see something dodgy, can they speak up safely?
They absolutely need a way to. A clear, confidential reporting channel is essential. Some companies even offer incentives for reporting misconduct.
Encouraging whistleblowing, basically.
Encouraging vigilance and ethical behavior, yes. Shows the company's serious about it.
And management's role. How hands-on should they be with the financials day to day?
Well, they certainly shouldn't be MIA. They oversee financial reporting. They need to actively review the statements regularly, monthly or quarterly, not just annually.
And the details. Reconciliations.
Yes. Key accounts reconciled monthly, approved by management, and regular cash flow statements prepared to keep an eye on liquidity. These aren't optional extras. They're fundamental controls.
So pulling it all together, all these controls, the scrutiny, the oversight, what's the ultimate aim?
It's ensuring revenues and expenses are recorded properly in the right period, that no liabilities or expenses are conveniently forgotten.
Because that would inflate profits or assets, like understating liabilities schemes?
Exactly. And ultimately that the numbers in the financial statements are accurate, truthful, and give a transparent picture of the company's real financial situation. Accuracy and transparency, that's the goal.
Okay, perfect. Let's try and categorize this then. We've hit controls, red flags, pressures, safeguards. We've touched on how fraud happens, but what are the main types of fraudulent reporting schemes we're actually looking for? The common playbooks.
Right. Based on our discussion, they generally fall into about 5 main buckets. First, fictitious revenue schemes.
Making up sales, like those unrealistic receivable jumps.
Precisely. Recording revenue from sales that never occurred, maybe inventing customers. Pure fabrication.
Okay, number 2.
Improper timing schemes. This is messing with when things are recorded.
Like those end-of-quarter deals or pushing expenses into next year.
Exactly that. Manipulating the timing to make one period look better than it is.
Third type.
Understating liability schemes. Hiding or minimizing debts and expenses.
Or maybe capitalizing costs that should just be expenses.
Yes. Makes the company look less indebted, more profitable.
What's next?
Improper disclosure schemes. This is about hiding crucial information.
In the footnotes are the main statements, like hidden risks, related party deals.
Correct. Omitting or misrepresenting material facts that users of the reports need to know. Things that could change their decisions.
And the last one?
Improper asset valuation schemes. Fiddling with the value of assets.
Like the inventory that wasn't really there or wasn't worth as much. Inflating receivables, fixed assets.
Exactly. Overstating assets makes the balance sheet look healthier than reality. So yeah, those 5: fictitious revenue, timing, understating liabilities, improper disclosure, and asset valuation, they cover the main ways companies cook the books.
Wow. Fictitious revenue, improper timing, understating liabilities, improper disclosure, improper asset valuation. That really covers the landscape.
It does. And the red flags we talked about, they're the breadcrumbs leading you to these schemes.
What a journey. From foundational controls through number scrutiny, external pressures, oversight, it really paints a full picture. Understanding these indicators gives you such a powerful lens.
It really does. Detecting fraud isn't one single thing. It's that combination. Strong foundations, sharp eyes on the numbers, awareness of the pressures, and robust oversight. Knowledge really is power here, especially when you apply it.
So, the final thought for you, our listener. What does this all mean for you? Whether you're an investor, just a curious citizen, maybe working in business. How vigilant are you, really, when you see financial information? The tools to spot these red flags, they exist. We've laid a lot of them out today.
Absolutely.
But ultimately, critical thinking, that healthy skepticism, that remains your most essential asset in this financial detective work.